Well, good morning, everybody. Welcome to Coffee with Bob. Today, we're going to discuss strategies that can be used in a market downturn. And with me is Christina. Christina is a certified financial planner. She has been with H&A for 8 years and valued contributor, and my daughter.
Thank you. Happy to be here. Welcome to our second official episode of Coffee with Bob. We both have our cups of coffee,
right here,
and we hope you do too. This is a recording of this latest episode. As the folks who were trying to tune in live know, we had some technical difficulties. So thanks for bearing with us. And for those who weren't able to join us live, welcome. We hope you enjoyed the presentation. We're going to be bringing more of these to you in the coming weeks, every other Wednesday. So please feel free to pass those emails along. Everyone is invited, the more the merrier.
So this quote, "The Dow climbs a wall of worry," is an oldie but goodie on Wall Street. Another way of saying it is Warren Buffett's famous quote, "Be greedy when others are fearful, and fearful when others are greedy." So this correction, this bear market that we went through, we're now out of, actually is are part of the normal ebbs and flows of a market cycle.
Yep, so true. And so this chart that you see here on your screen, for those of you who have tuned in to previous Coffee with Bob episodes, you have seen this chart before. But just as a reminder, what you're looking at here is a 90-year history of annual S&P 500 returns. It's a really powerful picture. So all of these dips that you see here are representative of prior pandemics, the depression, recessions, acts of terrorism, war. All of these events at that time were considered unprecedented, just like today. But what this chart shows us is that despite those setbacks, the markets and the economy persevered and recovered. Every recovery is always going to look a little different, but in trying to navigate the current state of our economy and of the markets today, we can look to this chart. We can use history as our guide. Recoveries are inevitable, and what we can do in the meantime is use that volatility to your advantage. So H&A, everyone in H&A, we are all huge proponents of that long-term mindset in honestly every facet of life, but especially when it comes to investing. Staying invested for most individuals is so important, even throughout those periods of volatility, especially throughout those periods of volatility. And we believe so for two main reasons. So the first, when we work with people, at least, we get to know who they are, their families, their needs, priorities, and with them, we build a financial plan. And that plan includes goals. It includes shorter term incremental goals and longer term bigger goals as well. When you stay invested, you increase the chances of the goals you set within your financial plan to come to fruition. And that second reason we believe staying invested is advantageous. You set yourself up, you set your portfolio up to participate in those inevitable market rebounds. Now, that being said, that doesn't mean we're just going to sit on our hands and do nothing, right?
No, not here at H&A. So another H&A-ism that we live by is manage the things that we can control. We're big proponents of identifying the things that we can control and managing those, all for your benefit. That's how we approach things.
Absolutely. So what we're going to do is get into these actual strategies we're going to talk about. Not all of these are meant to apply to you all at one time or even during every single correction or period of volatility in the markets. But these are timeless strategies that we believe you can look to now and time again in the future and see if they apply to you in that given time. So let's talk about rebalancing. You guys have heard us talk about rebalancing before. We're going to get into just a little more detail about that today. Bob, do you want to talk about that?
So rebalancing is the process of returning one's portfolio to its stated risk budget. And simply, it is selling something that is high, that's exceeded its target range, and buying something that is low in anticipation of that going up. And if we've done our job correctly with you, we have talked with you about your unique goals. Maybe you've articulated those in writing with us. We've helped you build that financial plan, or we've just had a conversation. Either way, We've grown to understand your unique objectives, and chances are that we're going to execute that game plan with a rebalance.
Mm-hmm. Yep, all good points. So a couple things to keep in mind before you actually decide to rebalance your account. The first is review your risk tolerance. Periods of volatility, a market correction, that's a great opportunity to make sure that your allocation between stocks, bonds, and cash is right for you. And if you decide you need to make a change, you can do so. But we encourage you to talk with your advisor before you decide to actually make that change within your portfolio. It's a fundamental change. And that second thing you want to think about is severe market moves are usually that time, that opportunity for a rebalance. But what you're going to want to do is pay more attention to the percentage change in asset values within your portfolio rather than the dollar amount change of asset values. That percentage change is much more telling in terms of whether or not it is an opportune time and appropriate for a rebalance in your account. Finally, we believe that a strong rebalance strategy consists of three things. And the first is discipline. The second is a good mix of proactive and reactive procedures. And the third is a long-term mindset. Okay, so the second strategy, ROTH conversions, this is a really popular strategy that we see a lot of people look to during a market correction, but it doesn't always make sense for everyone. Mm-hmm. So Bob, do you want to talk about, what needs to be in place for it to make sense and why it would be advantageous to do a conversion during a correction rather than, let's say, at the top of the market?
So the ducks have to line up, the stars have to be aligned for a ROTH conversion to make sense for anyone. And a couple key components. First of all, it has to be affordable for you. What we mean by affordable is when you're in essence, with a ROTH conversion, you're prepaying taxes today in anticipation of the taxes you're paying today being less than the taxes you would pay in the future by a wide margin. And to pay those taxes today, you need to be able to do that with non-retirement assets. So you've got to have a pile of cash sitting aside that you could allocate to paying these taxes. So the reason folks consider it now is because you're getting a discount. The stock market is lower than it was 2 months ago, and so therefore stock prices are lower. If you convert stocks today into a Roth, the taxes paid would be on a lower value. So you're reducing your tax liability even more. Other key considerations with a Roth conversion are your need for the use of the IRA. We highly recommend that a Roth conversion, first of all, has to satisfy the 5-year rule, but you really need to look at it as we think a 13, 14, 15-year break even would be appropriate and conservative.
Okay, great. So putting cash to work can be a really great strategy to implement. And there's two main ways that you can do that. So the first is investing cash on hand. If you've got a lot of cash on the sidelines and you've been waiting for some kind of opportunity to do something with that cash besides, letting it sit in the bank, you could get it invested during a correction and reap those rewards of market growth down the road. Now, there's got to be a couple things in place for, in our opinion, for that to make sense for someone. The first is it's usually best to have a long-term mindset for that cash that you're going to get invested in the markets during a correction. And the second thing is that cash you're going to invest in the markets should only be above and beyond your emergency savings, of course. Doesn't always mean that we're going to just take that, chunk of money and dump it into the markets all at once. Sometimes we may take an opportunity and move a little more quickly, but sometimes that investment process, that investment into the market might be done over a period of 2 or 3, maybe even 4 months. We're going to be really strategic with it. And that's where working with your advisor will help you get the most out of taking advantage of that correction and getting that cash to work. So that second way you can get some cash, put some cash to work during a correction or during a downturn, you could think about accelerating your retirement plan contributions. Now, you should really only do this, in our opinion, if it works for your month-to-month cash flow. You don't want to make things too tight for you. But if you've got some extra cash flow on hand month over month, and you want to accelerate those contributions for that year, during that given time, during that period of market volatility, you're going to be putting more cash into the markets at that relative discount and hopefully reaping those rewards down the road. And the bottom line here is whether you do one or both of these strategies, you're going to be putting yourself in the position to participate in and take full advantage of market rebounds. Okay, Bob, do you want to talk about de-risking and what that can, the several things that can mean?
So, yep. So first, I would like to say that if we've done a good job, we understand your unique goals, and de-risk probably is not in order. But should there be a reason to de-risk, say, for example, you find that proverbial island that you want to buy and you're going to need cash to buy it, then we'll de-risk. And that's the process of selling assets that are more volatile and reallocating that to cash or bonds as an example. So we'd sell stocks, for example, and add to bonds or cash. You could go to cash completely. That probably for most people doesn't make sense unless there's an extenuating circumstance like you're going to buy something. But again, if we've done our job properly, we understand your unique goals and probably won't need to de-risk. We'll, in essence, just manage your account and provide good rebalances, good reallocations, and monitor your portfolio.
Okay, awesome. How about tax planning? Do you want to talk about these two strategies under tax planning?
Yeah, you're probably like me. You're proud to pay taxes. We live in the greatest country, I'm going to say that. And, but like most people, I don't want to pay any more than I have to. And that's how we think here at H&A, and that's how we think about your portfolio here at H&A. So we use some techniques, tax loss harvesting. Bernie and his team, Bobby, et cetera, and our investment committee looked at portfolios that are in taxable accounts earlier this year and identified accounts that and assets that were appropriate for tax loss harvesting, notified clients of that, and executed the game plan. And now we have a tax loss in the bank, so to speak, and we can use that to offset future gains, either this year or in future years, because realized losses are carried forward indefinitely. So that's in the bank, and it can be used in the future to offset gains and minimize your taxes. Realizing capital gains in lower income years, if your income is going to be lower this year, or if you believe that in the political landscape that the Democrats could gain control later, perhaps in the White House or in the Senate later this year, then, and if tax rates go up because of that, you might want to accelerate gains to this year or when the Republicans switch over to the Democrats, and recognizing that likely tax rates might change. So, these are all things that we think about internally and that we want to communicate with you and let you know that we're minimizing taxes.
So going back to the tax loss harvesting strategy, can you just go into a little more detail regarding offsetting losses versus gains and offsetting losses versus ordinary income?
So the way the tax law works, first of all, we'd recommend you talk to your CPA or your tax preparer. But the way the tax law works, to our understanding, pretty good about this, is that you can use your realized losses to offset realized gains. Eventually, everybody in their portfolio is going to have a realized gains, either through a rebalance or because you decide that it's the appropriate thing to do to sell something. So we're a big proponent, again, of managing the things that we can control. And one of the things that we want to do is we want to control when you realize gains and realize losses. It's much better to me to be in the driver's seat driving the car rather than be affected by somebody outside of your account. So we attempted to implement that in your portfolio. And again, you can use losses against gains to the extent that you don't have gains. You can use losses to offset some of your ordinary income up to $3,000 a year.
Okay, perfect. Thanks for that. Okay, so these last two strategies fall under the category of debt management, and I'm going to speak to these. There's two types of debt that we're going to talk about today. The first is your mortgage. So you could consider refinancing your mortgage during a time of a market downturn. And why can you do this? Well, when there is a market downturn or a market correction that coincides with some sort of economic hardship, like the situation we're in today, usually that results in a low interest rate environment. And that's also what we're seeing today. So a low interest rate environment is usually a great opportunity for you to reevaluate the monthly mortgage payments that you're making to your bank. Before you decide to actually refinance your mortgage, though, there are a couple of pieces of information that we really encourage you to make sure you understand fully. So the first is make sure you know all of those upfront administrative and other miscellaneous costs associated with the actual refinancing process. And the second is make sure you know what your new loan term is going to be. It's probably going to be a longer loan term. And the third is that longer loan term coupled with those lower monthly mortgage payments that you will likely get will result most likely in more interest being paid to the bank over the entire term of that new loan. So some people aren't okay with paying more interest to the bank. It's a huge decision, and you're going to just want to make sure that you get all of that information. And the second type of debt we're going to be talking about is consumer debt. So for example, credit card debt, notorious for high interest rates. So what you could do is consider accelerating those consumer debt payments. Why? Well, in periods of market volatility or a market downturn, it's typical that the interest rates you're paying on that consumer debt will most likely be higher than, be more than anything you might be expecting in the markets in your portfolio, at least in the near term, in the near future. So you could accelerate those debt payments, get that debt off the books, and stop paying that high interest rate. So that is all the strategies we have for today. There are honestly a lot more strategies we could talk about, specifically under the umbrella of tax planning and also estate planning. There's some estate planning strategies that you could potentially use depending on the complexity of your estate plan. So we really encourage you to talk with your tax advisor, talk with your estate planning attorney, talk with your financial advisor. If you don't have a CPA or an estate planning attorney, we can help you with that. Again, not all these strategies are meant to work for you all at once or during every market pullback or market correction, but these are timeless strategies that you can look to again and again. We don't have any questions today because, like we said at the beginning, this is a recording, but our emails are at the bottom of this screen, so is our phone number. And if you have any questions or if you want to talk through any of these strategies and see if they make sense for you, give us a call, email us anytime. Please use us as a resource. Our next Coffee with Bob episode is 2 weeks from today. That's the 27th. And I will be your host. I'm going to be interviewing Larry Schwartz of Midnight Blue Technology Services. It's an IT services company, and we're going to be talking about working from home and cybersecurity best practices. So stay tuned for that. We'll see you in a couple weeks. Again, please do reach out to us if you have any other questions.
Awesome. Have a great day, everybody.
Thank you.